Testing, testing. Okay. Testing. Testing. Testing, 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 testing. Testing. Ah, yes. Yes. Huh. So, we're back live. I didn't want to pass over the time, the cap on how long it takes for somebody to stream, and I wonder what to do in order for this whole thing to happen. There's a lot of things going on, and things are getting super intense. So, a lot of news coming in here, and a lot of talks about what rate cuts would do to the stock market. And mind you, we've been way above the 2% of the inflation rate for a long time, and it's just a matter of time. I feel like this could be it. Mind you, I'm looking at a video that Finance-A-Lot posted 19 hours ago, and mind you, this was let's see. This was a video that he reposted on Twitter. Let's go ahead and watch all together, shall we?
Apple's up more than 6% right now. Google about 3%, but Dell, Intel, Research Motion, and Microsoft are all to the upside. Look how strong.
Did not disappoint. 400 points higher. Yes, indeed. The market's roar higher. Last 30 minutes of trading as volatility once again rules the day.
Most of the techs this morning, if not all of them, have just exploded to the... Down 1.7% here, a loss of 37 points or so. Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16%. Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
Two-year note yields went from 190 to 166 in the blink of an eye.
On the NASDAQ, everything and more has been completely wiped out.
It was the worst day on Wall Street since the crash of 1987. From the financial capital of the world, the opening bell is going to ring in
5 seconds, and to be honest with you, we wish it wouldn't.
Traders here working the phone say a lot of their customers are freaked out. Oh my God! The Dow went down. They're focused on the Dow, not so focused on OPEC. Yes, OPEC did cut production by 1.5 million barrels per day.
Really, you're seeing just broad-based declines across all of the major technology sectors. Apple's under pressure. Yahoo down 8.5%.
Ooh,
Cisco 6.5%.
Apple was 91.32
Research in Motion
that day,
10%.
huh?
And we're not getting the bid one, and we're not getting the stock trading, and we see where the buyers are. We're just, every day they're pounding it.
The heightened financial turmoil that we have experienced of late may well lengthen the period of weak economic performance and further increase the risk to growth.
Can't look at it after you buy it. It's so horrible.
Losing streak in the Dow that in percentage terms puts it on par.
I wonder what Jim Cramer's reaction is going to be this time.
Close to that percentage loss those 2 days in 1929.
What started in America last year has now spread to every part of the world.
Really?
9% today. The Zetrodax over in Frankfurt is down by 9%. The Paris market down by 9%. Austria, which was briefly suspended earlier on in the day, is down by nearly 11%.
This market is as volatile as you'll ever see.
Traders say this is the craziest day they have ever seen in these markets. Veteran traders saying they've never seen anything like it. The movement in oil prices so fast, so fast.
Seconds to go until the start of trading at the New York Stock Exchange, and stocks are set to kick off lower, a whole lot lower.
eBay is down 6.5%. Really, you're seeing just broad-based declines across all of the major technology sectors. Apple's under pressure. Yahoo down 8.5%. Cisco 6.5%. Research in Motion 10%.
This could be the most serious recession in decades. And that means life, as most Americans know it, is about to change, in some cases dramatically.
Oh my God. Let's take a look at the comments here. So, let's see. Apparently the next sell-off will be much faster. Will it be? I mean, what's happening tomorrow morning? Wait, how do we look at this? Hold on. Oh no, I think I gotta look at Bitcoin. Oh. 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 That looks bad. Looks like a little head and shoulders there. What do you guys think about that pattern there, huh? Look at this. Look at this. I mean, I don't know. Is this considered a head, or is this the head right here? Oh no. Head. Head. Maybe. I don't know. But what if this is where everything starts to fall down? You have tomorrow at 10 o'clock in the morning, non-farm payrolls annual revision. Now let's go to ChatGPT here, since you know I'm a little addicted to ChatGPT, but just know that all of what is presented here on the stream, here in the Lion's Den, strictly, in my opinion, do your own research. This is not financial advice. This is only for educational, entertainment, and research purposes. Now we're gonna go ahead and ask questions, and just to let you know that ChatGPT can make mistakes all the time. Maybe sometimes, maybe 1% of the time. I don't know. Depends. Let's go ahead and let me go ahead and ask a question here. Okay. Because I'm actually curious about what are these revisions about and what is supposed to take place. And, at 10 o'clock in the morning tomorrow. Okay. Now, now, okay, hold on. I'm trying to. I can't do it. Okay, I can't do it. Non-farm payrolls annual revision. Now, ChatGPT, what can you tell me about non-farm payroll annual revision? ChatGPT here says, I guess we're gonna have to give it a second because maybe my computer is a little trash. But let's see. Now, all right. How does this even? Okay, no, I don't know. I've never done this before. Don't reply to that jerk. You jerk. Don't reply to that jerk. Oh, you're talking about ChatGPT. Okay, let's see. So, great question. Non-farm payroll annual revisions are an important but often overlooked part of the United States labor market data. Let me break it down simply and then go into more detail. So, what they are: non-farm payrolls, NFP, a monthly measure from the United States Bureau of Labor Statistics that tracks the number of jobs in the U.S. economy, excluding farm work, private household employees, and some nonprofit workers. Annual revision. Once a year, the BLS, or the Bureau of Labor Statistics, goes back and re-benchmarks the employment data to more accurate counts, mainly using unemployment insurance tax records from employers. This adjustment ensures that monthly survey-based data lines up with the most comprehensive job counts available. Why they happen? The monthly non-farm payrolls reports are based on a survey of 122,000 businesses and government agencies, covering about 666,000 work sites. It's funny how they use the number 666,000. But that's a sample, not a full census. Over time, sampling error and business changes, which includes births and deaths of firms, can cause the data to drift from reality. The annual revision process corrects this using user interface records, which cover over 97% of all jobs in the United States. Wait, what? Yo, what up, Eric? I heard they were gonna be OnlyFans leaks here. Oh, cheers, cheers. Good to see you on here. I need to post some links there. Yeah. Starting this fall. Hold on. I'm still eating food. How are you, man? What's been going on today? We're here talking about non-farm payroll annual revisions, which will be taking place tomorrow at 10 o'clock in the morning Eastern Time. And there are again a monthly measure from the U.S. Bureau of Labor Statistics that tracks the number of jobs in the U.S. economy, excluding farm work, private household employees, and some non-profit workers. So when they happen, so every August, the Bureau of Labor Statistics announces a preliminary estimate of how much payrolls will be revised. The final benchmark revisions are published with the January jobs report, which is released the first Friday of February. This adjustment revises the level of payrolls back 21 months, nearly 2 years. So why it matters? 1. Market impact. Big revisions can change the story of how strong or weak the labor market really was. Policy impact. The Fed, investors, and economists rely on non-farm payrolls data, which will lead to a downward revision. A downward revision might mean the labor market wasn't as hot as it seemed, while an upward one signals more strength. And credibility. It's a reminder that monthly non-farm payrolls numbers are estimates subject to significant adjustments. So, as an example, suppose 2023 data showed an average of plus 200,000 jobs a month. After the 2024 benchmark revision, that might be restated as plus 160,000 jobs a month if they overestimated, or plus 240,000 if underestimated. In recent years, revisions have ranged from about plus 500,000 jobs added to minus 500,000 jobs removed in total across the period. So in summary, non-farm payroll annual revisions are once-a-year adjustments where the Bureau of Labor Statistics trues up its monthly job estimates with more accurate employer tax data. They can significantly reshape the narrative of past labor market strength or weakness, and markets, especially bonds, foreign exchange, and equities, pay close attention when the new benchmark is announced. Now, that's they usually source the information with some links, but they didn't do that here. They will usually leave some sources here. So let me see. Where did you source this information from? By the way. So, ChatGPT says, he got so ChatGPT got the info from the Bureau of Labor Statistics dash employment situation technical notes. The BLS explains how monthly NFP data are compiled and how the annual benchmark revision works. So apparently it's somewhere here. So here is the website, bls.gov, and pretty much the summary of the revisions. So here, which says, with the release of January 2025 data on February 7, 2025, the Bureau of Labor Statistics introduced its annual revision to national estimates of employment, hours, and earnings from the current employment statistics monthly survey of non-farm establishments. The March 2024 benchmarked seasonally adjusted employment level for total non-farm employment is 157,517. Oh wait, 157,517,000. The not seasonally adjusted benchmarked employment level is 156,612,000. Compared with the sample-based seasonally adjusted published estimate for March 2024, total non-farm employment had a revision of negative 589,000 or negative 0.4%. The not seasonally adjusted total non-farm employment estimate was revised by negative 598,000 or negative 0.4%. So here, table 1, as you see here, presents revised total non-farm employment data on a seasonally adjusted basis for January 2024 through December of 2024. So the revised data for April 2024 forward incorporate the effect of applying the rate of change measured by the sample to the new benchmark employment level, as well as updated net birth death model forecasts and new seasonal adjustment factors. Revisions to November and December also reflect the incorporation of additional sample receipts. So for more information about the methodology of benchmarking in the CES program, it tells me to click on benchmark and the calculation section of the CS blah 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 blah. And you see here the levels as revised, as previously published, the difference over the month changes and all that good stuff. Let's see. I wonder if there's anything as of right now. How do we see that? Oh, so only because I found information missing or wiped from news outlets. Oh yeah. Yeah, they probably find a way to like kind of meddle with ChatGPT to not be able to find the answers that you're really looking for. So imagine that. What up, Chris? Hey. Oh, okay. Oh, it's missing. Got it. Alright, would you like me to check the most recent August 2025 preliminary benchmark revision from the BLS site right now so you have the freshest number? Oh, listen to that. Yes, please. Yeah, for real. Searching Amazon? Oh, okay. So, check this out. Look at all this information that just got printed out. displayed. How's it going, Chris? So it says here, here's where the information about non-farm payroll annual benchmark revisions come from. So the 2025 preliminary benchmark revision is scheduled for release on September 9th, 2025 at 10 a.m. Eastern Time. That's tomorrow at 10 a.m. Whale alert, whale alert. Along with the QCEW data for first quarter of 2025, which is the quarterly census of employment and wages. So the county employment and wages release for first quarter of 2025 is scheduled to be released also at 10 a.m. tomorrow, Eastern Time. And this data is derived from the state unemployment insurance tax records and is used by the Bureau of Labor Statistics to provide a comprehensive count of employment and wages. What is the QCEW data? It is based on nearly all employers in the U.S. filing quarterly reports. It counts filled jobs, so the data counts filled jobs regardless of whether they are full-time or part-time. It uses unemployment insurance records from state unemployment insurance tax records. It's used for benchmark revisions, for updating other employment data, like the CES, which provides a preliminary estimate of job growth and revisions to payrolls. So the final benchmark revision incorporating these adjustments will be published with the January 2026 employment situation release scheduled for February 2026. Now, analysis and commentary from media and think tanks. See, we were just talking about media. Eric, that CBS News reports that markets expect the BLS's preliminary August benchmark revision, which is going to be released tomorrow, to show that employment during the 12 months through March 2025 was roughly 775,000 jobs lower than previously reported. Ooh. So you listen to that? Did you listen to this? Here, this is the source right here. CBS News reported major job revisions Tuesday could show the labor market is weaker than previously thought. Oh boy. So then it says that the report could draw attention from the Trump administration as the president last month questioned the validity of the monthly jobs report and fired the commission of the BLS. You guys heard about that? So he fired the commission of the BLS after the data included a significant downward revision. Hiring experts and economists point to a job market that's stalling out as some businesses are bearing increased tariff costs while others are tapping artificial intelligence as a way to lower labor costs and replace workers. Ooh. The revision could show that employment was reduced by about 775,000 for the 12 months through March. And that would indicate that the average monthly job growth in 2024 actually stood at 100,000 per month, down from the 165,000 previously reported. The revision would cover only the first 3 months of Mr. Trump's second administration, with the bulk of the time frame occurring in the last year of former President Biden's administration. Now, job growth has slowed dramatically in recent months, with the employers adding an average of 29,000 jobs each month from June through August, the most recent BLS data shows. Could be biased, CBS, it could be biased. be biased, or could be one-sided. Who knows? Let's just talk about what happened with the last annual revision. So the BLS issued a major downward revision last year for the same annual data, showing that employers added 818,000 jobs fewer jobs in the last 12 months ended March 2024 than previously estimated. That lowered average monthly job growth for the period to 174,000, down from the initial estimate of 242,000. At the time, the downward revision was seen as evidence that the labor market was showing cracks, and it was viewed as paving the way for the Federal Reserve to cut rates at its September 2024 meeting. So then here it says, what does this mean for a Fed rate cut? The Fed will be focused on analyzing recent economic data, such as the latest jobs report, and the next consumer price index, which will be issued on September 11. Economists expect the CPI to show an annualized increase of 2.9% in August, higher than the prior month's 2.7%, and well above the Fed's goal of reaching a 2% annual rate. So then, with the labor market hitting a wall in recent months, economists now expect the Federal Reserve to cut its benchmark rate at its September 17 meeting. It says here that the only question is whether the Fed might usher in a jumbo cut of 0.5 percentage points or opt for the typical cut of 0.25 percentage points. It says here, quote, market odds currently see a 100% chance of a Fed rate cut this month, with a small constituent seeing an outsized 50 basis point cut on September 17 within the realm of possibility. But he added, if the August consumer price index comes in hotter than expected on September 11, that quote-unquote would likely throw cold water on the idea that the Fed is considering an outsized September rate cut. And I'm just going to read this last part here, that President Trump has repeatedly lashed out at Powell this year over the Fed's decision to keep interest rates level. And in June, Mr. Trump publicly mused over whether to fire him, although many legal experts say it's not clear he has the constitutional authority to do so. Powell's term as Fed chair ends on May 15, 2026. No. Bloomberg. Now here we're back at ChatGPT. Again, all of this is just strictly in my opinion, and just know that this is for educational, research, and entertainment purposes. And I appreciate y'all to join here and for us to research and read what's being said here, so we can pretty much figure out what could happen tomorrow and in the next 9 days from now, when when the Fed meeting happens. But here Bloomberg notes that economists from Wells Fargo, Comerica Bank, Pantheon Macroeconomics, Bank of America, RBC, and others anticipate a downward revision approaching 800,000 jobs for the year ending March 2025. So that sounds a little negative there too, right? The American Action Forum offers a quote unquote back of the envelope estimate that revisions may range from negative 470,000 to negative 740,000 jobs, projecting average monthly job growth between 88,000 and 110,000, below the 149,000 previously reported. Investing.com also anticipates a preliminary revision between negative 450,000 and negative 750,000 jobs, aligning with the outlook that the labor market may be weaker than previously estimated. So the context and background. The Congressional Research Service notes that the 2024 preliminary revision that was released August 2024 estimated a downward adjustment of 818,000 jobs for the year ending March 2024, and the final 2025 benchmark revision released February 2025 confirmed a 598,000 job downward adjustment. So what's next, right? I want to know what's the worst that can happen in addition to the upcoming Fed meeting if the interest rates are cut by 0.5 percentage what is it, percentage points? Did I read that? Hey. Yeah, percentage points. The reaction. What would happen to the stock market, theoretically speaking? Here we go. So, so it says, got it. You're asking about the risks of a 0.5 percentage point Fed rate cut versus the usual 0.25 and what it could mean for the stock market. Oh, you know what? I forgot to add. You know what? Let me reiterate that question. Let me see what you said here. I used to work for people the head of the BLS, and they are career phonies. Career government leeches. They hated business-minded people, so they were looking for sheep. So yeah, basically they're looking for fall guys and women. Let's just say the government was employing money. Chill. So let me reiterate this question. What's the worst that can happen in regards to tomorrow when non-farm payroll annual revisions are released at 10 a.m. tomorrow? Oh, I need to be like very detailed with this. Tomorrow, September 9th, 2025 at 10 a.m. Eastern Time. In addition to the upcoming Fed meeting on September 17, 2025 at 2 o'clock p.m. Eastern Time. If the interest rates are cut. Okay, let me see. Look what it says here. So in ChatGPT's opinion, speculating here, it's ChatGPT says, listen to this, right? It says, you're tying together, bring it, here. It says, you're tying together two very big catalysts. So it tells me you're tying together two very big catalysts. Tomorrow's non-farm payroll annual benchmark revision and the FOMC rate decision on the September 17th. Let's think through the worst case scenario in terms of market reaction. Number one, tomorrow's benchmark revision. If the annual non-farm payrolls revision comes in at the bearish end, and let's say as an example, negative 800,000 jobs or more, here's the likely fallout. Here's the narrative shift. Investors suddenly realized the labor market was far weaker than thought for the past year. Recession fears. The economy may have been running closer to stall speed, not just quote-unquote cooling. Bond yields could drop sharply as traders price in more Fed cuts and recession risk. Equities, stocks could sell off on growth fears, including earnings pressure, possible recession. The dollar likely weakens since weaker labor markets suggest less Fed tightening and slower U.S. growth. How is that dollar doing so far? Can we take a look? And also Bitcoin with a interesting sell-off here, down negative 0.53%. The dollar is down negative 0.04% at 97.40, which has hit a 7-week low as jobs gloom heightens Fed cut chances. But let's see here. Open it, Lion. Open it! Now, the Fed meeting on September 17. If the Fed cuts 0.50%, 50 basis points, more than the market consensus, likely 25 basis points, the signal, it screams, the Fed is worried, quote unquote. A bigger cut means policymakers see economic deterioration. Worst case interpretation, markets think the Fed is panicking because the economy is already tipping. Stocks could actually fall on the day or the cut, which includes the classic quote-unquote bad news is bad news dynamic. Bonds, the yields collapse further. The yield curve steepens at the short end. Let's look at that yield curve, shall we? Yield curve today. How does that look? Let's take a look at how that yield curve looks like right now. How do we take a look at the live yield curve? Let's see. I think it's right here. US Treasury yield curve.com. Shit. Let's see. Wow. Yeah. Yeah. How do we do this? How do we do this? I'm lagging. I'm lagging here. What is this? How do you do this? Where's the curve? Well, it's higher than where it was. For sure. The 30-year. Okay. Wait. Alright. Wait, hold on. How do we do? Okay, I can't. It's lagging my computer. Darn it. Anyways, well, we'll figure it out later. So, yields collapse further. Yield curve steepens at the short end. Dollar weakens sharply, potentially fueling capital outflows to emerging markets or commodities. What does that mean? That means your oil. Oil will be probably rising, even though it has been looking a little bit weak so far. But when you take a look at it from a long term, looks like it's kind of holding off here. You see right here? Looks like a double bottom here trying to play out here. How to do this? How to do this? Just like that? Ah, that's funny. We change this to like, I don't know, yellow? Sure. Let me like take this, take that thing out. Let me see, where's the table? The background. How do I take off this? Hold on. The border? The label? I don't know. Alright, whatever. You get the point. Looks like a double bottom. Whatever. Could be a good time to low too on oil. If you take a look at IMPP, IMPP has been moving once again. This bird. This was at like under $3 back in August 15, and it's rising. It's rising. It hit the high of 389. So. Anyways, so yeah, the dollar weakens sharply, potentially fueling capital outflows to emerging markets or commodities. And not only just, oil, but also, silver. Look at silver. She's $41.24 an ounce. Gold is pumping. Look at gold during the past 2 weeks. From like 3,310 to now a new all-time high again of $3,646.46 an ounce. It's up almost 0.20% in the green. Look at that. Look at it. Look at the pumpage. Right? So number 3, the combined worst-case chain reaction. So number 1, September 9th, the non-farm payroll revision shows a negative 800,000 jobs, crushing confidence in the resilient, quote-unquote, resilient labor market story. That narrative ends tomorrow, if that happens. Number 2, markets immediately price in not just cuts, but a hard landing recession scenario. And that's in bold letters. Hard landing recession scenario. Number 3, September 17. The Fed validates those fears with a 50 basis points emergency feeling cut. Market reaction. Number 4, equities. Short-term sharp sell-off. Growth scare. Sectors hit hardest. Listen to this. Cyclicals. Banks. Small caps. Examples of, hey, look at that. How'd you know? You're listening to me, aren't you? Cyclical stocks are tied to the economic cycle, performing best during economic expansion and declining during downturns. They are common in industries that produce wants or non-essential goods and services as opposed to needs. So, for example, cyclical stocks such as automotive, people are more likely to buy new cars and trucks when they feel financially secure. During recessions, they tend to repair their existing vehicles instead. So, for example, companies like Ford, General Motors, Tesla. And speaking of Tesla, today, Tesla was getting smoked. Was getting sacked pretty hard. Closed negative 1.27%. From a high of $358.44 to as low as $344.84. So yeah, that was a big downturn for sure. Damn Tesla. And that's like, I mean, like, look what happened this past week. It was like at the bottom of 325, going as high as 358, to then come back down here to 345. I wonder, right? So then, how is Ford looking like right now? Because I know that stock is as stable as hell. I mean, like, does it even move? Ford. This is how Ford looks like on the daily. And we're talking about since what? Summer of 2022? Summer of 2022. I mean, like, look, come on now, look at this. And you're getting paid dividends too at the same time. So it's been literally on this sloping channel, bouncing up and down year after year, from like 10 and change all the way up to like almost $17, back down to 11 and change, back up to like $15.50, down to like below $10, then up to 15, then up to like 8.40 or something, and now like back up to like 12. So what? Now it's gonna turn back around and go all the way down to like $7.80, below $8, because that's what it kind of looks like to me. And if you know those two catalysts, and if that market reaction, I mean, I don't know, but like, if things are not looking good in terms of I mean, especially like when it comes to the labor markets. Yeah, dude, you don't remember when Ford went up to like $25 or something like that? Dude, I remember this. I remember this, and I can't believe I did not get in. Actually, no. What am I talking about? I did kind of play around 2021. And look at this. You had Ford during CV19, when everything started shutting down. It was worth around $4.20, maybe $4 to be exact. And this thing went up and boomed all the way to as high as $25.87, and then coming back down. And then don't forget, there was a period of time where they stopped paying divvies, and then after November 18th, they started paying divvies again at 10 cents. So every quarter was 10 cents each. 10 cents each. Oh, 15 cents here. So they raised it up to 5 cents. February 10th of 2023, they actually paid out 80 cents per share. And then back to 15 cents, then 15 cents, then 15 cents. Then 33 cents here, February 15th, 15 cents, 15 cents, 15 cents, 30 cents. Okay, so I guess every fourth quarter, they paid like, higher. So it's kind of like a bonus. So that means 15 cents, 30 cents. So 15 cents, 15 cents. Next earnings plus divvies, 15 cents, and then the next quarter afterwards, they'll pay like a little bonus there. Which, I mean, to be honest, that's not bad, you know? That's not bad if you think about it. And if they continue to pay divvies, and Ford for being such a cheap company, I mean, at this price, you gotta admit, like, shoot, like you wish you would have gotten in at $4 from that time. And then now, like, dipping to low, these levels here around probably like 8 and change, like, if everything does transpire and then we have a crash, and theoretically speaking, and then we have Ford going back down to these levels, pandemic levels, who knows. So then let's just continue here for the examples of cyclical stocks. So then you have travel and hospitality. So consumers with more discretionary income are more likely to take vacations, book flights, stay in hotels, and eat at restaurants. These industries suffer significantly when people cut back on non-essential spending. So then these companies, for example, include Delta Airlines, Marriott International, and Royal Caribbean. Damn it. So the next one is retail. So retailers, especially those selling discretionary or luxury items, are highly sensitive to consumer spending habits. For example, companies like Amazon, Home Depot, Nike, Starbucks. Now, I just realized this past week, Lululemon had earnings, and it sucked ass. Like, you go to the chart right now for Lululemon. It looks pretty bad. Like, you're talking about a stock that was worth, where was it at the peak? Let's look at the monthly chart. Look at that. Oof. I fall. Look at the monthly chart on Lululemon. Look how much it has grown since 2017. As a matter of fact, I mean, like, oh my goodness. I've never even heard of Lululemon since till like last year. I'm so serious. I've only seen like 1 or 2 stores in New York City. And I'm like looking, I'm like, Lululemon, what do they sell? Obviously it says Athletica, so they sell athletic things, clothing and sportswear and all that, whatever. But I'm like, wow. I mean, like, this is just disgusting. Yet, like, they had beaten earnings. Um, they had beating. Well, they had missed on revenue that one time, July 2024. But then they had been more consistent the next couple of earnings, except for the last earnings that was reported last week on Thursday, September 4th, which they had missed revenue by negative 7.84 million. And that caused the stock to drop even more. But yeah, and then you had, you know, people ransacking Lululemon stores in states like cities like, you know, Los Angeles in California. I don't know about anywhere else, but I'm sure they have lost a lot of money constantly. But look at that. I mean, like, you're talking about a stock that was worth, to my surprise, $516.39. I heard William was modeling some Lulu wear today. Oh. Oh gosh. But dude, $516.39. The month of December of 2023 to now as low as 162.80, which closed today 168.10. Which, looking at the 4-hour chart, and look at this big, I mean, look at the big reaction here. This is what happened after earnings. From $207.77 all the way to 173 to 166 to as low as 163.98. Oh no, 162.80 today, this morning, before market open. And now it looks like it's somewhat trying to, what, you think it's gonna bounce back up again? Because now there's this big gap here to somehow fill. But then if it rejects the edge of this box at 176, then to fall again, I don't know, maybe. But yeah, I mean, that's what the FEG here shows. Now you have this big fair value gap. But, you know, I don't know how the stock moves. And in terms of playing options in Lululemon, I don't even know. It kind of looks like it's rejecting a little bit, though. Maybe Lululemon doesn't come back from this, and Lululemon starts to fall even lower. Where is the next gap for Lululemon, actually? Let me see. Let's see where the next gap is. Where is that next gap? Wow. The next fair value gap here is at around 140 to like 160, within that range. And that's from March. Whoa. So Lululemon is now back to COVID levels. You believe that? So yeah, right here. The low here was 128.85 back in March 18 of 2020. Then the next level below that, you see. Let me actually draw a line here so I won't get lost. And then let's see. This is a deep analysis here. Very deep. Profound. Very profound. And then the next lowest here, the next bottom, back then was at $110.71. Back in December 24th of 2018. Oh, there's a gap here. There is a gap here. Probably starting from here. I want to say it's right here. That is somewhere between 107 and 110 a share. Imagine Lululemon coming back down to those levels, huh? That would be insane. And it's not really that far off either. So who knows? Like, this thing comes out very negative. Who knows? Anyways, damn, what about Nike? Remember when Nike dropped hard? Oh yeah, of course. Can you get that on the AI for us? Yeah. No. There is crime in New York. It's been worse. But yeah, drive safe, bro. And listen to the podcast of Lion of All Trades here in the Lion's Den, where we discuss here on this episode what could happen when non-farm payroll revisions and their basis points of 50% points cut affects the entire market. What would be those specific sectors that would be affected? Well, the next one that we're going to talk about here, we just went over retail, and Amazon. I can't imagine, and including the tariffs too. On top of that, Starbucks. Oh boy. We talked about Nike. Remember Nike? Nike here. Remember when it took a huge dive? And then we have those two gaps. You remember, Eric? You remember? And we were like, "Yo, we gotta play Nike. Nike's coming back, right?" So Nike ended up filling those two gaps from the earnings from March 20th of 2025. The first gap being from 59 and change all the way to $62.50. Then to the next gap here between $68, almost $69 to about $71, which actually was filled right away after the next earnings, which took place June 26th of 2025, which jumped from 60.82 to as high as 74.19 and managing to come back up to as high as 79.99, pretty much $80 since August 25th. Now looks like Nike is retreating from 80 and dropped back down. Nike did pay dividends on September 2nd, just last week, at around 40 cents per share. The payment date will be released on October 1st of 2025. But ever since then, Nike gapped down from 79.13 to as low as $74, then to 73.63, and it looks like it's looking a bit more bearish here. I don't know what's going on with Nike, but it is closing. It's getting closer to falling right underneath those EMA ribbons. And see, how do I do this? There was a way. Let's see, how do I do this? Oh, I can't even do it. There was a way to do it. I don't know how to do it. Okay, it's not like that. Oh, wait, what? Oh, okay, I'm so confused right now. Hold on. Okay, here. All right. Anyways, so it's looking bearish. in my opinion. So I'm thinking whether this actually will consider filling the gap back down. Nike probably seeing $70 on the horizon, or maybe 69 within the next couple of weeks. If it actually reacts to what happens tomorrow and September 17th, I'd say that would be the bearish case scenario. Plus, I mean, it made a huge gap now. From that gap up during last earnings. So now you have that situation here. So now it has to fill the gap back down to like 63, 64 bucks, in my opinion. If bearish, of course, if everything starts to go crazy and whatnot. It's my analysis there. Anyways, the next example of cyclical stocks is the housing and construction sector. So these industries rely on consumer confidence and spending for new home purchases and renovations. A downturn often results in delayed projects and lower demand for building materials and home furnishings. So for example, companies like D.R. Horton, Lowe's, and the Home Depot. So you already have retail. Home Depot is involved in retail, and now housing and construction. So now we go to banking. So the banking industry is cyclical because its profits are linked to economic growth and interest rates. During a boom, lending activity and consumer borrowing increase, but a recession can cause higher loan defaults and less demand for banking services. So for example, JP Morgan, Bank of America, and Wells Fargo, and so and so. Then you have industrial. So companies that produce raw materials, heavy equipment, and other industrial goods that tend to do well during economic expansion when construction and manufacturing are robust. So for example, Caterpillar and Rio Tinto. And then last but not least, technology. So while some technology stocks have become consumer staples, many are still cyclical. Purchases of new electronics like smartphones and computers can be deferred during tough economic times. I can't afford the new Samsung Galaxy. I'm going to have to just buy myself a new Obama phone. Or maybe a Nokia. So, companies that are affected are Apple and Netflix. Tough times, man. You can't really afford a subscription to Netflix. That have to result into, downloading software that makes you watch TV shows for free. So let's continue here. So the sectors hit hardest, once again, cyclical, banks, and small caps. Small caps. So, let's see. So, examples of small cap stocks. Small cap stocks are typically from companies with a market cap between $250 million and $2 billion. Though the exact range can vary, and many of these are still in high growth phases and tend to be more volatile than large cap stocks. So you have examples here shown as emerging technology companies. So younger companies in sectors like cybersecurity, software, software, or quantum computing, such as Quantum Computing Inc., ticker symbol QUBT, Where is that? There you go. So QUBT on the daily, it's somehow. Oh, what is this? Let me drag it over here. What you got over here? What is this? What is this? Oh, we're back into that range, huh? Does it look like it's probably bottoming out here at around 14 and change, 15? It closed at $15.24. What are we doing here? I'm not too sure. Earnings was not good. August 14th was the release of the earnings last quarter for QUBT. What else? Rigetti, IONQ. I mean, they all look like the same chart, honestly. RGTX is the ETF. QSI, I think that's a different. That's what, no, that's different. Quantum Corporation here. Looks like, whoa. QMCO has an actual interesting setup here. Why does this remind me of a short squeeze setup? Not but like, you know, like if you look like at a daily chart of some small cap that's squeezed back then in the past, and then you had the big sell off, and it comes all the way to like a bottom, and then you see it bottoming out at a certain price and such. There is a bottom here that looks like it wants to establish, in my opinion, and there has been a couple of green or bullish FVGs or fair value gaps here that seems to show that QMCO is looking to want a rebound and perhaps try to come back to certain levels here, probably above $8 a share, in my opinion, maybe, or maybe as high as $8.50, somewhere around this bearish fair value gap as shown here. I'd be surprised. Then 5 hours ago, Quantum to announce fiscal first quarter 2026 financial results on Wednesday, September 10th. So that's in 2 days. Perhaps that could kind of like turn things up for the stock. I'm gonna have to keep an eye on QMCO. As a matter of fact, did I hold on? Let me see something real quick, cause I want to know QMCO. QMCO. Oh, okay. Oh, real quick, Lion, you never seen them Lululemon shorts? Oh gosh. And then what? And then see William wearing those Lululemon shorts? I'm gonna barf. Oh shoot. You know what? QMCO looks a little hot. You have 1,734,752 shares short interest. In short interest. Then you have the short interest ratio at 7.19 days to cover. Then you have a short interest percentage flow of 13.22%. So it's actually, it's on that threshold that would be considered as a high short interest. Which means, right? Well, you be doing a topless stream of GME earnings? Hold up. I think I'll be hairy enough for you to not see my nipples. So, let's see. So, yeah, I don't know why, but QMCO. We're gonna have to keep a close eye on that ticker. QMCO, not financial advice. Do your own research. But Quantum Corporation has some interesting numbers there on the basic stats on Fintel. That makes me wonder. Plus, 11 hours ago, they did have 200,000 supposed short shares available, with a cost to borrow or short borrow fee rate from start to max here at 34.79% for tomorrow. Makes me wonder. Right, I'm gonna have to do some more digging. But here to continue. So emerging technology companies, cybersecurity, software, quantum computing. Then you have biotechnology and medical devices, specialized healthcare firms like Cirrus Corporation, which focuses on blood safety. Niche market players, so smaller companies with specialized products or services. For example, Guided Software provides software for property and casualty insurers. Then you have newer retail businesses, Eric, brands with strong potential that are still building a national presence. Some smaller companies listed in the aggressive small cap lists on Yahoo Finance include Krispy Kreme, D-Nuts, and Hertz. D-Nut Hertz. These nuts hurts. They put that together, Krispy Kreme and Hertz. And industrials, so smaller manufacturing or equipment firms like Helmerich and Payne, which is a drilling contractor and is an example with a market cap on the smaller end. So Krispy Kreme with some Hertz. We've looked at D-Nut or Krispy Kreme for quite some time. It has dropped though. It was down negative 6.80% on the close at $3.15. Okay. They do pay dividends, but it's only 3.5 cents per quarter. And last earnings, their earnings per share was lower by a lot, but their revenue was just over in the green with 1.07 million. And for some reason, there was a big rally here that took place around the end of June to almost the end of July, from $2.50 roundabout to as high as $5.73 before dropping very hard back down to about $2.90. In the ways that I see Krispy Kreme, and the weekly looks a little scary with those EMA ribbons here, kind of looking like it wants to come back down too. There is a chance that's something that could happen with Adina, in my opinion, especially with this setup here, that this could, drop below $3 again. And you can see it here on the RSI too, with this pulling back and heading towards these dots that represent an uptrend. And once the RSI line breaks below that trend line supposed to react in more bearish activity. If you look at it on the daily, you can see that that is definitely a bearish. It did the move here, and it's a lot lower underneath that uptrend. And now you see the red dots here, which indicate a downtrend beginning, and perhaps we'll look for more downside here. Once again, towards like the middle of the month. So we're probably gonna have to watch for those levels there and see if it drops at $3, and if it falls below $3 and heads back to like maybe I don't know $2.75, and see if it bottoms out from there. And then who knows what will happen then, So yeah, D-Nut. You had D-Nut. Let's see what else. And then Hertz. Where is Hertz? I don't think I have Hertz here. Hertz is at $5.98. That was actually closed at 9.32%. So that's interesting. Anywho, so now that we got that over with, I feel like we've been talking for a long time. But defensive plays, for example, utilities and staples, and tech with strong balance sheets might hold up better. And defensive. Let's see, defensive stocks. Okay, so in terms of defensive stocks, right? So these companies offer products and services people need regardless of economic conditions, and they are also known as non-cyclical or consumer staples, which industries include consumer staples like companies that produce household goods and food and beverages that see consistent demand, like Procter & Gamble, which sells essential products like toiletries and cleaning supplies. Coca-Cola, which offers beverages that people continue to buy because they're addicted, and Coca-Cola has drugs in it. No, I'm just joking. Then you have Walmart and Costco, which are the retailers of everyday necessities, and General Mills, who produces packaged foods and snacks. Then you have utilities, providers of essential services like electricity, water, and gas, maintain steady demand. So, for example, Duke Energy, which is a regulated electric and gas company, and American Waterworks, and AWK, a water and wastewater provider. Then healthcare, pharmaceuticals, and other healthcare providers remain in demand regardless of the economic climate. So J&J and PFE. Then you have defense. Companies that produce defense goods have consistent government contracts, making them more resilient to economic downturns. So Lockheed Martin, a global aerospace and defense company. Then bonds, huge rally in treasuries, which includes yields plunging. Commodities, gold and silver rip higher, which would be a hedge against the weak dollar, plus Fed panicking. Oil could fall, it says here. Demand fears, oil could fall. The US dollar falls against major currencies, against the euro, the Japanese yen, and the CHF. The CHF, which is, oh, that's not what that is. So essentially, worst case equals a mini crisis of confidence, which results in markets fear the Fed sees a problem bigger than investors expected, right? So number 4, historical parallel. January 2028. No, I mean January 2008. Weak payroll revisions plus surprise Fed cuts resulted in equities tanking because investors concluded that a recession was underway. All right, so that happened once before. And then March of 2020, you had the big emergency rate cuts that didn't help stocks until fiscal plus Fed balance sheet stimulus came in tandem. So if this worst case plays out, markets may view the Fed cut as a red flag and not a relief. So the bottom line is that the worst that can happen is that the non-farm payroll revisions tomorrow confirmed the labor market was much weaker than thought. Then the Fed cuts to 50 basis points to quote unquote get ahead of the slowdown, and stocks interpreting it as panic, leading to a sharp risk-off sell-off. So for example, the S&P down, VIX up, gold/bonds up, US dollar down. Okay. So that was, that was the read there. So with those two catalysts, right? We just gotta see. We just gotta see what could happen. Now, if you wanted me to look at Lululemon shorts, sure. Let's look at the Lululemon shorts. Let's see how those look like, huh? What would William look like with these shorts on? How about that? Everybody who stopped by, don't forget to show some love in the Lion's Den. Hit that like button, share and subscribe. It's free. It doesn't cost you a thing. That's all I ask is for you to just show some love. Nothing more. And I know I don't have the music on. I should have the music on, to make things a little more chill, right? And that reminds me, I gotta make new music. I need to make like 100 more new tracks, so it will actually last the 8 hours of market hours. But yeah, these shorts are ugly. I'm sorry. I think I just predicted the downfall of Lululemon. Anyway, let's see. There was a post here by Big JR. I need to find it because it was from Twitter and it did say something about oil. I need to find out. I need to know. I need to know what's up with that. I need to know what's up with that. Where could it be? Where could it be? I'm gonna have to type in here oil. Okay, you got Konoko Phillips here posted on September 3rd that says that they would cut workforce by 20 to 25% as part of a broad restructuring. Okay, that was that. Okay, I think no, it was definitely not that. It was definitely not that. Where's that post at? They said something about oil. I know he did. Crude? Let me see. For right, crude here? Crude oil? No. Where can I look this up? Okay, big. No. Okay, big. I'm gonna have to manually look up for this this post. I know it wasn't that long. It wasn't that long. I know. I just know it. I just gotta find it. I know it's there sometime. I know. Hold on. Okay, it's before that. Talk about NRGV, NUKK. Getting hotter. Okay. Dick's Sporting Goods. All right. Yeah, the athletic retail giants emerge in $2.4 billion deal this month. Oh, wait. Let me go ahead and read that. It was an article from this month. Read into that. Disney smells like another insider buy for NRGV. NRGV actually hit $2 again today. So not only that, but Finger. Talk about Finger. Oh my god, Finger actually came back too. Where? Sorry, was it this one? No, it was not this one. Wow, was it really last month? Jeez. I can't believe it was that long. Really? My goodness. Oh my god, Ma. Was it really that long ago? Jeez. No. Can't be. I know it wasn't that long ago. It was either here or it was either, I don't know, it was either here or it was it's either here or it was on charting. Maybe it was charting. Shout out to Big JR and Mark R too. Shout out to Mark R. Okay, so it wasn't on this channel. Was it on Trading Floor? Might have been on Trading Floor. Let's see. No, it wasn't. Okay, what on earth? Huh. Where was it? What was it posted? Was it posted here? Nope. I don't know where it was. Yeah, I don't know where I don't know where to find it. This is crazy. Where did he post it? Where did he post? Where did he post? It's definitely not here. Couldn't be here. Was it tinfoil? Was it tinfoil? Was it tinfoil? No, I don't think it was tinfoil. Wait, what is this? Oh, right. Gosh, okay. Oh, put this for what? Roblox? Oh, right. I forgot about Roblox. Robloxers. Robloxos. Where's Roblox at? Roblox. And Roblox looks like it's topping over too. Is it selling off or no? I think it's still ranging. Finger. Let me look at Finger real quick. Finger, surprisingly, was in the green. Big candle there. Big pop. It actually traded just underneath the 30-day average volume of 327.81 thousand. Traded at a total of 313,000. The trading day before that was a low of 135.41 thousand, and then before that 161.03 thousand. But yeah, that's a big bounce. That is a big bounce here, actually. And not only that, but this raises my eyebrows a lot because this looks like a nice bounce. And it bottomed out higher than the last low, which was at around $1.35. So something might be going on with Finger right now. And also on the weekly, somehow in the weekly, especially on the parabolic RSI, we have 3 bottoms here. And remember, this is just me being hypothetical. But here, 1, 2, and 3. And then you have the downtrend here, and then the RSI line, and then what if it just breaks out all of a sudden here, leading to probably like the end of September into October, causing Finger to run up past $2 again, which seems to be like the major resistance so far right now. So we gotta see if this is indeed the breakout that everyone has been waiting for Finger, or if it's gonna be another fake out. But overall, I mean, like, this is surprising to me. But we don't even know. We don't know until it starts to break the next resistances, like at 170, 175. And then we'll start, raising more eyebrows and figuring, well, this looks very promising, and knowing if Finger will actually go back over $2. That'll be lit. I know Matt mentioned about Railtown. Railtown is, wow, it actually does not look very pleasant, in my opinion. It looks a bit bearish. And it looks like it's losing steam just as much as it looks like people are losing patience, because once again somebody had fed these people's minds with the idea, and also telling them to leave all of their other positions just to get into this one particular stock, in my opinion, which I feel like it's considered pumping, and which I consider it to be, possibly manipulating the stock, or attempting to, which is not a good look, because if you look at it from the daily chart, the EMA ribbons are crossing below each other, which would result in more bearish activity, in my opinion, which would result in more downside to the these levels here, maybe 35 cents or maybe 30 cents, 30 to 35 cents here. And then that might cause more triggers to people to jump out and start exiting their positions because they've had enough and they don't want more of this droppage. And then they're gonna want to, I don't know, go back into finger or something like that, or I don't know, wherever they want to go, which is up to them. But gosh, I mean, like, this is just, I don't know. I can't explain it, but you know what? Oh yeah, I just think that that's how I feel. It's just my opinion, but yeah, I've never even thought about, getting into this stock at all. But Energy V does sound nice though, in my opinion. Whoa, what was this? Oh, UFG was up 16.30%. Now see, this is a stock that would definitely give you some returns. And just seeing how this stock has been trading for the past week or so, that surprised me. And we're talking about bottoming out here at around below $2, around 170, maybe 150, and then slowly coming back up. And not only that, but beating earnings too, slightly, and coming up as high as $7.70. Then you have Up, which was another one that I talked about since maybe around $1 and change. And then this stock ended up going up as high as $3.50. When did I start talking about Up again? Let's see. Up. So, let's see. Yeah. Let me see. If I go to new. Oh, wait a minute. Oh, this was today. This was today. So I need to look at that one there. Close this. Where's Up though? Energy. Oh, since no. August 26th, it was moving up. August 25th. I don't know. What is this? Do you want me to build you a trading playbook for both scenarios? Sure. Yes, please. Thank you. Sharp -3 to 5% over days. Wow. Hedge with SPY puts, fixed calls, short dated around September 17th. September 17th expiration? No. Wow. I gotta figure that out. Long gold, silver, or futures? Tight stops. Long treasuries. Defense ETFs. How do they play this? Okay. So the non-farm payroll revision, negative 800K or worse, plus the Fed cuts 50 basis points equals market interpreting a quote-unquote hard landing, which will result in an expected move of the S&P 500, Dow, Russell 2000 to drop sharp, negative 3 to 5 days over days. Sectors hit: financial, cyclical, small caps, defensive rotations, utilities, staples, mega cap tech with cash reserves may outperform but still face pressure. Hedge with SPY puts, fixed calls. As an example, theoretically, not financial advice, short dated, rotate into defense bonds, expected move, yields plunge, TLT, long bonds rallies hard. Go long on treasuries, TLT, blah, 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 blah. Gold and silver spikes on Fed panic, US dollar weakness, oil drops on demand fears. So that might just suck. That might just suck. Hedge aim currencies. Scenario B, relief, dovish, Goldilocks. Oh, so if the non-farm payroll revision is modest, so somewhere between negative 300,000 to negative 500,000 range, plus the Fed cutting only 25 basis points. Apparently, supposedly, theoretically, hypothetically, the markets would see a quote-unquote soft landing, which an expected move would have the S&P 500 and NASDAQ rally, which tech would lead. Sectors would also include growth tech, semiconductors, consumer discretionary outperforming, QQQ calls or semis, long high beta stocks like ARK, Tesla, Nvidia, and such. Yields drifting lower but orderly, curve doesn't scream panic. Gold still supported lower rates but not explosive. Oil stable or even higher if soft landing supports demand. Light gold long energy equities. Risk management dates matter. September 9th. Could start the moves. Straddles. Blah 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 blah. Alright, so I could just go ahead and quote this here. Sure. Can I actually bold? Actually, yes. Actually, let me delete this. Let me do it again. Let me highlight this and put it in bold. Worst case. Relief case. Bold. 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 Just that 7 seconds. Let's see. results. Okay. Huh. Do you want me to quantify possible S&P 500 levels? Like target downside, upside ranges based on the NFP, blah, 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 blah. Nah. That's okay. Oh, wait a minute. Oh. They're talking about Octo. Wow. Huh. Octo. Let's talk about GameStop real quick, because I know there's earnings tomorrow. Jesus. All right. You know what? 1 second. Be right back. Gotta use the bathroom. Alright, so I'm back, and I need to hurry up and eat this before it gets bad, because the last time I ate this donut looking thing, it went bad and I was upset. So no, I'm not gonna let that happen again, so I'm gonna eat this. Wait. Oh. Ooh. Whoa. They put a lot of ube in this. It's so purple. Ooh. Oh, yeah. I feel like they put a lot of ube in this. Jeez. Wow. That's nuts. Apparently, supposedly, allegedly, the expert analysts at Zacks Research are giving GME a price target of $13.50, suggesting a market cap of approximately $6 billion, while GameStop sits comfortably on $9 billion plus in cash and cash equivalents and Bitcoin. Don't forget about that, because there will be, I believe, reporting their holdings in this upcoming earnings, and when they file their, I guess, 10K, or I forgot what it was. And with no near-term debt. Then it says here, Zacks needs to add sponsored by Citadel to their price targets. It's funny. So yeah, they're calling for another 40% down move, and they're not the only ones reporting this. But remember from last time, I believe I posted it on Discord, but they had here, I posted it on the 4th, and this was released by Tip Ranks, and it says here that the video game retailer GameStop Corp, which would set to report its second quarter 2025 results tomorrow, the meme stock has dropped about 27% year to date, hurt by weaker sales in its retail business, concern over its Bitcoin push, and doubts about how it will use its large cash pile. Wall Street analyst Alicia Reese of Wedbush remains bearish, with her price target pointing to more than 40% downside from current levels. So So Wall Street analysts expect the company to report earnings of 19 cents per share versus 1 cent in the year ago quarter. Also, revenue expected to increase by 13%. So from the year ago quarter to $900 million. With second quarter earnings just tomorrow, investors will be looking for signs that GameStop can stabilize its operations and deliver a clear long-term strategy. Right? So, give me 1 second. So, right here, it seems like in the last reported quarter, GameStop reported earnings per share of 17 cents, well ahead of the 4 cents estimate. The company also posted a net profit of $44.8 million, marking a sharp improvement from a loss in the prior year. However, revenue fell 17% year over year to 732.4 million. Jesus. Missing analyst expectations of 754.2 million, as weakness persisted in its core video game hardware and software business. So not only, right, Zax, but Alicia from Wedbush, who continues to maintain a sell rating. According to her, she sees more than 40% downside for GameStop based on her price target of $13.50 per share, as seen right here. That's just one sell rating. Although, and that's from July 2nd. So 2 months ago, when this action was initiated and her position was a sell and the price target $13.50. Then somebody from TR OpenAI, Rena Kuritex, with a price target between $23.50 and $24.50, position hold upside 7.08%. The action was reiterated, and this was posted on September 3rd. But you have Felicia and you have now Zax Research. It makes me wonder. I wonder if this is just my imagination here, but this is included with what's to happen in the coming next days, including tomorrow and next week. I don't know. There must be something going on in the background. But they're going to want to make this happen. And it's going to suck for a lot of people. In my opinion, of course. It could very well just hold on.
More concerning if they use the cash to do some stupid ass shit.
What is this?
I'm okay with the cash position. I don't mind cash positions. I know I get where you're coming from, Ming, but I don't care about that downside protection. I would be more concerned, Ming, if they used the cash to do some stupid ass shit, like some dumbass acquisition. You know what I mean? That's when I'd be like, what the hell are you doing? But sitting on it, chilling, just have you sitting back like, nah. Let's just build up that balance sheet straight. Know what I mean? I don't mind that. Traders will mind that because they really betting on a short squeeze, the buyback, blah blah blah. That gets like the short-term thinkers maybe upset. Not me. I don't care. I don't give a shit. I just want that. I'm so happy they have that cash in the books right now. I said that before. I was one of the people who thought they should have been doing those buybacks back in the like 9 months ago, and then I was happy when as the pandemic was unfolding. I'm like, I hope they didn't do as many as I hoped, and they had all that cash in their bank, like 500 million in cash. I'm like, oh, that's sick. Even right now, I'm still happy they have that.
So that day, on that day, sitting at 500 million, compared to now sitting at 9.1 billion. Imagine that, right? Fun fact of the day, posted by Watchtower on Twitter here, says Nestle holds $5.5 billion in cash. Market cap is $251 billion. GameStop holds $9.1 billion in cash. Market cap is only $10.34 billion. The cash will appear for the first time in GME's balance sheet tomorrow. Supposedly, apparently, all that stuff. What does Hen Akamatsu say on Twitter? Back in 2020, GameStop was a low-margin brick-and-mortar retailer that was steadily declining. Gross margins had collapsed in the mid-20s, and EPS was running deep in the red at around negative 1.3. I guess, what am I talking about? $1.30, negative $1.30 per share. The short thesis was simple: revenues were falling, profitability was gone, and bankruptcy was only a matter of time for the shorts. Fast forward to now, and the numbers tell a very different story. Gross margins have recovered to more than 30%, right back near historical highs, and EPS has swung back into positive territory at plus 0.5. Free cash flow is positive again, and the balance sheet is fortified with nearly $9.1 billion of liquidity and no meaningful near-term debt. GameStop is no longer a retailer burning cash. It has become a lean, profitable, cash-generating shell with a fortress balance sheet. Even with the offerings, the stock is now solidified. The story has shifted from survival to optionality now. Not whether it will fail, but how Ryan Cohen chooses to deploy the war chest. Interesting here. Let me just share this with the peeps in the lines down here. Some interesting information there. Yeah. I like. Wait, what? What is this? Wait, what? A PSA arcade in Las Vegas?
$50 for a chance at a multi-$1,000 PSA 10 Pokemon card right here in the casino.
Let's do it. $50 for something huge.
What is
Come on,
this?
Pokemon.
Come on, Pokemon. PSA 10, graded Pokemon pack, official by PSA.
I'm about to get a hollow Charizard.
What is this?
Please wait a few seconds.
Huh.
Guys, this is gambling on Pokemon cards. I'm about
Really?
to sell this on eBay.
Yeah, let's see what it's worth. We're definitely going to sell this on eBay. So we've never done a card pull before. This is interesting.
Yo, is that a Charizard?
Wow. Look at that. The 2021 Pokemon Japanese VMAX. Wow, Charizard VMAX Climax. PSA 10. 187.